Welcome to Theo Trade. This is Don Kaufman. July 13th, 2020, seconds after the cash close on this Monday afternoon. The sell-side activity has clearly commenced inside of the NASDAQ, dragging down the S&Ps along with it. Let's get to work on tonight's video. A few major points that I want to make. Number one, what we're seeing inside of the NASDAQ, this is very likely just the beginning of some of the sell-side activity. Of course, I'm going to explain in detail why we believe that this is just the beginning of some of the sell-side activity. The second point that I want to make, and this is critically important for any of you that hold long positions, the death of diversification is here, and that is very distinct inside of today's trading session. So with those 2 points, let's get to work. Let's talk a little bit about the NASDAQ. I mean, one of the first things that's the real standout inside of the NASDAQ, people, it's just the range. So here we're bringing up the NASDAQ futures. Now, you may not necessarily trade the NASDAQ futures. You may not know the NASDAQ futures, but know this. The range that we saw inside of today's trading session, I know that the NASDAQ only finished down 240 points, okay, which is a whopping, 2.2%. Being a little facetious with that, it's not that big of a move to the downside. Nevertheless, the full range of the day is nothing less, again, than phenomenal. When you're talking about, 500-point ranges in a day in a major product like the NASDAQ, and if you know a little bit about NASDAQ or NASDAQ futures, listen, 500 points, that is a very serious day, and there's serious implications moving forward. But as I said just a moment ago, it's not the range on the day that has really caught my attention. Let's actually cruise over to the QQQ. As many of you that have tuned in to some of the nightly videos, I have been very critical of the NASDAQ lately, and specifically have called for the NASDAQ an impending sell-off. Well, here is, in effect, the beginning of that sell-off. But before I go any further, this is not the big down move that I was looking for. There's very likely more downside capacity to this particular move. Again, we were looking for a very brutal day inside of the NASDAQ. Today, looks like the beginning of it. Again, down just over 2%. But what's got me believing that there's going to be more downside capacity to this marketplace? It has everything to do with the statistical, moves, all right, or implied volatility. One of the things that we pointed out, and one of the reasons we became so bearish on the NASDAQ in the very near term. And again, our calls were last Wednesday and last Friday for, again, fairly significant move down inside of the NASDAQ. And that call was very largely predicated on the sheer velocity of the move to the upside. But it's not just looking at a chart and going like, well, we moved from here up here and it's a percentage move. It has everything to do with the fact that we literally smashed outside the expected move in 2 consecutive weeks. Okay, and if you go back to any real recent history inside of the NASDAQ, any time, the NASDAQ or a major index product for that matter had smashed outside of its representative expected moves on any given week, and 2 consecutive weeks for that matter, there have been very broad-based pullbacks. Obviously, this is the beginning of it. Now, the reason, and I think even more appropriately and important at this point, the reason I don't believe that the move in the NASDAQ is necessarily done. Today, we actually got almost to the high, all right, or to the upper edge of the NASDAQ expected move. Now, for those of you, if you've never heard the terminology expected move, it's what the option marketplace depicts risk to be. And, maybe you don't put necessarily a lot of weight inside of the NASDAQ or inside of options. You absolutely unequivocally should. I mean, if you look at the QQQ today, they traded, 1.7 million options in there, which is almost 2 times the norm. But the option markets, are moving the underlyings. How? Through hedging activity. So what you're seeing represented by this expected move, and this is the most important aspect of it, these aren't just some fictitious lines, based around a Fibonacci sequence. Not picking on the Fibonacci. All right, just a little bit, because I got your 618 right here, buddy. I'm not picking on that. What I am doing, though, is I'm telling you that the lines on the screen here, they represent an average of the option pricing. And markets, tend to gravitate inside of the expected move. It's not just a line. It's skin in the game. There's literally, billions of dollars being traded on either side of this marketplace. So I'll give you a quick example here. Inside of something like the QQQ, if it says, that this product is supposed to move, for instance, up $8 or down $8, okay, that's because the options market is pricing it to move $8. All right, so why now do I believe a more violent pullback is likely in play? It's because we actually did not breach the downside of the expected move. And that, and only that, would give us the distinct feeling that at that point in time, we go, okay, if we break through the bottom of the expected move, then things might be a little bit overdone. But it's not just the fact that we haven't breached the lower edge of the expected move. It was the violence inside, okay, of the what? Well, here we're looking at volatility futures. We're looking at the VIX. Okay, traders, you got to understand this. All right, they were buying. Again, they were buying volatility. Let me clean this up so you can see it. They were buying volatility well before the sell side activity kind of commenced. This was like a coordinated effort to be buying volatility pretty much out of the gate today, and I think that most people missed that. Now, again, I'm not a big proponent of the VIX. Nevertheless, the VIX was on the bid all day long. You got to realize, okay, the VIX is the S&P 500. And yet, if you take a look at the S&P 500 today, well, the S&P 500 out of the gate this morning, it ripped. I mean, it really ripped from roughly 3,200 all the way into the 3,226. I mean, you had the S&Ps rip into the upside, but at the same time as the S&Ps were ripping to the upside, again, I'll reiterate, there were net buyers of volatility. That was before any of the risk was seen, and they bought volatility into today's close with both hands, people. The VIX spiked by 5 full points. That's almost a 20% gain. If I look to the bottom of the screen, they were buying volatility everywhere out of the gate this morning, and most people missed it. Again, it was one of the greatest intraday setups that we have had literally in years. And when I say one of the greatest intraday setups, I'll give you the intraday trade that we actually pulled off today. It was specific to the spiders. For those of you kind of interested, you know what? In this particular account, I didn't trade a huge amount today. Okay, but here is ultimately a one lot we bought for 88 cents. We actually got out of the trade for $7.17, right? I put on the trade predicated on the idea that the marketplace could have a pullback in large part because the volatility was amped up throughout the course of the trading session. So again, kind of a neat little trade that we pulled off there on an intraday basis. But let's push all that aside again for a second. Yes, the volatility tended to tip us off. And that's not a frequent occurrence that you see volatility rocketing like that, because at the time that volatility was taking off to the upside, quite frankly, the NASDAQ was still on the bid to the upside. If you took a look at a stock like Tesla, which is a phenomenal move today, only ended up down 3%, but Tesla had cruised clear into the almost 1,800 level, only to settle just below 1,500. Again, stocks were bid, volatility is bid at the exact same time. We really felt that it provided us, again, the quintessential intraday setup. But as I said, there were two things that I really wanted to cover on this evening's video. The first was the fact that I would still anticipate, some sharp sell side activity inside of the QQQ. Just the bottom line is, it doesn't have to do, listen, there's a lot of news breaking in the marketplace. I could go all day about all the events, but you've seen news and you've seen all the events over umpteen trading sessions out there. Push it all aside for a second. This was a product, okay, that cracked the upside of the expected move 2 weeks in a row. We believe it's probably not done until there's a violent move outside the expected move to the downside, and that may be precisely what we're in store for in just the days to come inside of the NASDAQ. Now, the second point that I wanted to make on this evening's video has everything to do with diversification, and it's dead. And there's just today, again, it was the final nail in the coffin for diversification. The reason I want to bring up diversification is so many of your portfolios are, for instance, people are, I own the S&P 500. I am well diversified. We'll take a look at your spiders today. The spiders closed down just over 1%. The scary portion of this, and the real scary story, there's earnings coming out tomorrow morning inside of the financials. The financials, they happen to actually be bid up by about 0.4%. You had a day where the S&Ps were actually off by 1% with the financials bid higher on the trading day. You had a day where the S&Ps are off by the tune of 1%, where the energy sector, okay, really was down and yet down mildly. You have a day, again, where the S&Ps are off 1%, where there's some big market players here, okay, that are like up on the trading session. And I cannot stress this enough. Okay, when I say diversification is dead, the market caps now of a Microsoft, of an Apple, of a Netflix, I'm even including Netflix in this now, Facebook, Amazon, Google, Tesla's right there with us, okay? They are just too heavy for the market right now. And ultimately, these underlyings, if we see heavy sell side activity, no matter what, the S&Ps are going under and going under heavily at this point. Now, I know that the financials are coming out with earnings in the morning. You're going to hear from the likes of JP Morgan, right? You hear from Wells, Citi, okay? None of that is going to matter at all. Those earnings will be completely discounted. In fact, when you start looking at those individual products and you start looking at something like JP Morgan, they're already discounting the ability for big moves to occur in these products. And you say, why do you say that? Take a look at the volatility, all right? The volatility, and here is JP Morgan with 4 days remaining is 66%. That's due to earnings, okay? In the next month out is 56%. There's a very minimal, okay, differential between front vol and back vol. That's indicative of, well, not a huge amount of movement being priced in. So even if earnings were to come out and they were spectacular in a JP Morgan or a Citi, okay, or a Wells, it's going to have very little impact on the overall marketplace. This marketplace is in trouble right now. And trouble, it has a name. It's the monsters of tech. And this is the area that you want to have all your focus on in tomorrow's session. This is actually the symbol that we built. It's Facebook plus Apple plus Microsoft plus Google plus Amazon. Yeah, I'm extracting, Tesla from this for the day. And yeah, I'm extracting Netflix from it. But again, the sell side activity in here was downright vicious. This is actually what drove the broader marketplace. The problem when I start talking about diversification, we literally can have 5 stocks that have the capacity to absolutely smoke the broader S&P 500. If these 5 stocks go, what it's going to cause, it's going to proliferate through all of your mutual funds and create sell side activity in the broader marketplace. Again, thank you very much, Apple. Okay, but if you start looking at the market capitalization of Apple at $1.65 trillion, okay, or something like Microsoft at roughly $1.57 trillion, these market caps, everything else pales in comparison. And you start looking again at the S&P 500, like it's okay, there's 500 stocks in there. But do any of them really matter? Because when you add up 400 out of the 500 stocks, okay, they don't even equal the capacity of a Microsoft or an Apple. Again, I will go into detail in this, all right, in just the days to come here at TheoTrade. But you have to understand right now, okay, what you're seeing on your screen, all right, is the end, if you will, of diversification, at least for the foreseeable future. We've known this, we've been on it, but today is one of the most hideous displays that the entire marketplace can be pulled deep under by literally 5 different products. All right. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. There is much more to come on this front. Let some of the sell side activity in the NASDAQ kind of commence. If you do get a short-term bounce, could be a good opportunity to step in on the short side in the very near term. Good night, everybody. Bye-bye.